How to value your SaaS business. Is your business worth what you think it is? A lot of founders overestimate the valuation of their business. I see this as such a common mistake in acquisitions, and that scares buyers away. Let's break down how to accurately value your business so you can sell with confidence. Why valuation matters. Before you sell, you need to know what your business is worth and why. If you price too high, buyers will walk away. You will scare them and you will not get a deal done. But if you price too low, you're going to leave money on the table. So getting this right is absolutely crucial. A realistic valuation makes your business more attractive to buyers and speeds up the sale. An unrealistic valuation, again, will cause your deal to not go through and everybody loses in these scenarios. Now, here's the most common valuation methods. These are three main ways buyers value a business. The first is going to be EBITDA multiples. This is most common for profitable businesses. EBITDA equals earnings before interest, taxes, depreciation, and amortization. That's a big one. Buyers typically will pay 3 to 6 times EBITDA for SaaS businesses or other online businesses. As an example, this means if your business is generating $500,000 per year in net profit, your business could be worth between $1.5 million to $3 million, which is massive. And other factors still include growth, risk, industry trends, stuff like that. But rule of thumb, 3 to 6 times EBITDA. The second would be revenue multiples. Now, this is for high growth SaaS startups. This is for businesses growing between 100% and above per year. Absolutely just going through the roof with growth. And this is because the business is growing so fast, it's not yet profitable. Everything is being reinvested to continue the growth rate. SaaS startups with strong growth can sell between 2 to 5 times revenue or more, depending on the buyer. More commonly, we do see EBITDA multiples, but with the right strategic buyer, this is definitely possible. But again, growth needs to be there. As an example, if you're at 1 million in annual recurring revenue, you might sell for $2 to $5 million, but only if the metrics are absolutely exceptional. Now, here's some factors to increase your valuation, which should be on every founder's mind. Buyers don't just look at numbers, they look at risk and opportunity. If you want to increase your valuation, here's some things that you could potentially do. Increase your profit margins. When you have high profit margins, the more money you keep, the more valuable your business is. That simple. Recurring revenue. Subscription models get the highest valuations because they're predictable. They allow buyers to forecast out the return on investment from the acquisition. Strong customer retention, low churn equals more value. And again, more predictable revenue, more healthy revenue, which could definitely increase the valuation of your business. Operational efficiency. If your business runs without you, buyers will pay more. That is such a huge advantage for you in acquisition conversations. So if the business is entirely reliant on you right now as the founder, find ways to delegate more. Find ways to reduce the operational risk of you leaving the business and everything falling apart. And then future growth potential. Could a new buyer step in, pull in a few new growth levers, or double down on what's been working in the past and see some additional growth? All these things add up to your final valuation. So start optimizing these before taking your business to market, and you'll see a much higher multiple and final valuation when you exit. And again, valuation is part art and part science, but getting it right is key to selling successfully. If you want to dive into this a bit more with the Acquire.com team, we'd be happy to walk you through valuation multiples, what we're seeing in the market, what we think we could get your business acquired for, and help make that happen.